Good afternoon. This is Brian Shannon from Alpha Trends Blogspot. It's Friday, finally, September 22nd, 2006, and we had another down session for the market. And the NASDAQ 100 that you see on the screen right here, the QQQQ, has closed below the 200-day moving average, which is kind of a psychological hit to the bulls a little bit. I think that a lot of people were hoping it could close above that level and hold on to the gains, the initial gains that we saw from the Fed meeting. As you can see from the 10-minute chart here, that all of the gains from the Fed meeting have been given up. Basically we had that gap open on Wednesday, and I don't know whether it's closed above or below that, but I'd say that it's given up just about the entire thing. I'm not going to check to see the exact penny, but it's anyone that bought pretty much over the last couple days is in a losing position. And today we saw some stabilization after yesterday's sell-off. We've got a 2-minute chart right here, and you can see that this sell-off yesterday afternoon did continue through this morning. But then we started seeing this little pattern of higher lows, and then we had a higher high late here in the day, and these moving averages are starting to turn back higher. So perhaps we're seeing a little bit of a stabilization here. We'll see what happens next week. We're still in a healthy uptrend here on the daily time frame, but as I've been mentioning, we're at a very critical level here on the weekly time frame, and that really has me just being overall cautious in this area. If you take a 2/3 retracement from the year high to the year low, you can see that comes in right around this area. We've also got that, again, I'm going to point out, this is where we've got that 200-day moving average, which is now declining, or continues to decline. And we've got this prior level of resistance, which has been acting as support. Now, the 200-day moving average doesn't have to act as resistance, just as the 50-day doesn't have to act as support or resistance. But generally, moving averages are a good reference point to compare price to. And when we have moving averages crisscrossing, it represents indecision. So right now, with the 10 above the 20 above the 50 on the daily time frame, it tells me that the short-term, intermediate, and longer-term do remain higher, and that we ought to give the benefit of the doubt to the buyers. We still do have this series of higher highs and higher lows, and I was saying that a close below 39.45 is what would break this uptrend, this pattern of higher highs and higher lows, and that's where we had this prior resistance in here as well. Yesterday, I was most concerned about the semiconductors, and we saw a little bit further decline in there, a little more weakness, and you can see that market also hasn't been able to get a push up through the 200-day moving average, so it's looking a little bit more bearish. And we saw a bigger volume here today as the market, initially traded higher during the week, but closed near the lows for the week. So that's got me still a little bit concerned. However, I continue to believe that. Actually, we've taken out this low right here, which does not bode well, I don't think, for the rest of the market. So I was hoping that 3250, I'm sorry, 3350 would be that level of support that held, but we, saw that level throughout the day acted as slight resistance. Now, it doesn't mean the market's going to stay down here, but if it can get back above that 3350 on Monday and Tuesday and kind of hold above there, I think that'll give me a little bit more confidence. But we still do have this declining 5-day moving average telling us be careful in here. And the biggest area of concern for me remains with these mid caps. And yesterday I was saying that a close below 135 would really concern me. We closed just about this at this level. It did make a lower low, but it didn't close below it. So we're going to have to continue to keep a very close eye on these mid caps, because this is looking like a big bearish flag to me. And if that's the case, then we've got a lot of trouble coming for these mid-cap stocks. And the mid-caps really were the leaders over the last couple of years. So we've seen, increasing volume on the way down in here, followed by low volume rallies up in here. In the last 2 weeks, we've had big volume without further upside progress, which typically equals distribution. So, as far as a measured move, if we went, if we said this was A to B, and then we took B to C and C to potentially D, we'd be somewhere down in here, and that would obviously not be a good sign for the overall market. So this is the area that gives me the most concern right now, and we've got to keep a very careful eye on the mid caps. The S&P 500, the spiders SPY, failed to make that higher high that most people were looking for this week, and as I said, I thought earlier in the week that if we saw a new high, that it would probably be a good area to sell rather than to buy, because you have to ask yourself always these two questions. Where has the market come from? Well, it's just rallied in the last 2 months from 122.5 up to 133. Where does it have the potential to go before it's likely to meet a potential source of supply that might slow it down or resistance? We're right there. So why on earth would you be looking to buy up here? Let the headlines talk about all this stuff, and let the real amateurs get involved up at these levels. But we've been long, correctly so, and this shorter term time frame told us it's time to be more cautious, especially now that we're back below that 5-day moving average. That 5-day moving average is declining, so I think it's neutral at best case for the next 2 days or so, and we'll have to see what the market gives us. We've still got an uptrend here, so I'm still overall bullish, but we're getting down to this trend line. We're getting to a very critical level, and I think the next few weeks, 2 to 4 weeks, are going to be very critical for the way this market unfolds for the rest of the year. And more on that later this weekend. Let's take a look at the individual stocks I've been mentioning. Charter Communications, CHTR, I had mentioned yesterday as a purchase candidate at $1.53. I had mentioned a stop at $1.48, so probably should have been stopped out of that one for a small loss if you're still in it. Stop, I would say, probably goes below today's lows at 146. I do own a small piece. I'd forgotten that I bought it yesterday, actually, in another account. But it's a very small position, 2,500 shares, and I'm still long from actually $1.53 yesterday. So, again, the daily chart still looks good. It acts okay, so I'm going to give it the benefit of the doubt here for a little bit while longer. CCJ, this is Kamiko, and I had suggested the stop at 39.05, and I don't know if you guys put these stops in, but if you put the stops in, the specialist is going to see them, and if the specialist sees them, guess what? He's going to go up there and grab them. I did not put my stop in. I saw the stock up there at 39.09, and I said, no way am I going to cover this thing. I covered down late in the day, down right at S2. Again, I don't know why I traded the stock. I broke one of these little rules I have, on a sticky note on my computer, which is if it's a New York Stock Exchange stock, only participate in options. These specialists are crooks. They're horrible. I'm done talking about the specialist, but basically the stock still looks lower. I think that I was looking for 37.50 puts. Unfortunately, they don't have any. They don't have any in that strike because I still think the stock looks weak. If you got stopped out, don't send hate mail to me. Send it to the New York Stock Exchange because they're the guys that rip you off. Anyways, if you're still in it, I'd take your profits and maybe buy some puts on it. BTU. Yesterday I had mentioned what's the hardest job on Wall Street? The hardest job on Wall Street is picking bottoms. I said, well, I'm going to give it a shot anyways, and wouldn't you know it? It proves to be the case. Stock gapped higher this morning. I had suggested that what we were looking for was a rally and then a failure. A failure, a move below $36 a share, and then a move back above $36.30, which occurred right here, and then a stop 40 cents away, which was taken out. And all I can say about this is I told you yesterday that it's the toughest job on Wall Street to pick bottoms. I've never been very good at it. The MACD divergence that I pointed out is the best way that I know of to look for potential turning points. But the only thing that is good here is the MACD is one very small piece of the puzzle. And it's a very complicated puzzle, the stock market, that is. And we can make it as complicated or simple as we want. But the bottom line is, at the end of the day, the thing that separates a good trader and a bad trader is money management. That's why if you're going to attempt such a high risk trade, because the trend is clearly lower, anyone can see that, like I said yesterday. So that makes the trade much higher risk. So you want to be trading small positions, number one. Secondly, you have to honor your stops, because getting stopped out at 35.90 sure beats still holding it $1 lower and, sitting there hoping, wishing, that something good is going to happen. Oil continued lower again today. We're looking at the USO right here, United States Oil Fund. This is the ETF. And I thought that this big volume might have stamped a short-term turning point low. It didn't, though. And that's trading for you. There's no guarantees. There's no 100% trades. The best thing to understand is that it's money management and position sizing, risk management, that is going to get you ahead at the end of the day. It's defense that wins the game. SIMO, Silicon Motion Technology. I wanted to buy this stock on some strength above $16.60 today. You can see that never occurred, so no reason to get involved in there. It looks like the stock is heading back down. No reason to get involved here. CHRW was a stock I was interested in on the short side. Looks like it's making this bigger top here on a weekly time frame. The daily looks like it's finding, this resistance and all these tails up here at the declining 50-day moving average. What we were looking for in here was a rally initially up to about $44.70. Obviously, that never occurred. The stock was weak from the beginning and continued weak throughout the day, so no reason to get involved in that one. And finally, we had Monster. Monster Worldwide. This is one that I had suggested also was a short sale. And what I was looking for in Monster was a rally first up to 37.20. We got that rally, and right here. And then what we wanted to do was sell the stock short below $37 a share once that occurred. So your short should have been entered right around this area. I had suggested a stop at 37.45 and a target near $36 a share, so you should still be in this stock with a stop, I think, at this point at about $36.85. That'll do it for this wrap up here. Trading involves risk. These are my ideas, nobody else. Nobody pays me to put these ideas up here. If you decide to trade them, you're responsible for your own decisions. Don't come crying at me if you lose money. The market is risky. Our job as participants in the market is to control risk. That is your job, to take high probability bets and control the risk where you can. Thanks again for listening, and I'll be back this weekend with another video with ideas for next week.